Reconciliation of bank statements. Okay, so this part was introduced in the financial accounting ACT 211, but here I want to recover it so that to refresh your memory. Okay, and it is important because only after reconciliation we can get the real or correct cash balance. Okay, yeah. So the firm usually they have two books to record the change of cash or the balance of cash. One is the firm's book. Okay, yeah. So this is actually based on the journal entries posting the accounting information system, and the other one is bank statement. Okay, yeah, because most cash actually were recorded or deposit into the bank. Okay, that's the part of the internal control of cash. Okay, and usually the balance of the bank statement and the firm statement they're not equal. Okay, this happens because the timing issue about the cash transaction. Okay, some deposits or disbursements were recorded in the firm's book while they are not updated in the bank statement. Or sometimes some cash transaction happen in the bank statement, but they were not updated in the firm's book. Okay, so that's the reason why there is a difference between these two statements or balance. So we should reconcile these two books to get the correct cash balance. Okay, so in this table we have the list of the adjustments or the reasons of the difference. Okay, and for example, the deposits in transit, so this is cash inflow were recorded in the firm's book, so we don't have to make adjustment in the firm's book because it was already recorded. But sometimes the deposit take days to be updated in the bank statement, right? So the firm should manually make adjustment to their bank statement, okay, and record it as addition to the original bank statement. Okay, and sometimes the bank has some errors by changing the balance of cash because of errors. Okay, the bank's errors, and these errors, because they are from the bank side, they should be corrected in the bank statement. Okay, if for some other information they're not they were recorded by bank, but they were not recorded in the firm's book, so we should make adjustment to the firm's book. For example, the bank's credit collections, which were not yet recorded in the firm's book. Okay, yeah, because they were recorded in the bank statement, so we don't need to update or change the balance of bank statement. So what we do is there are cash inflows, so we manually add this amount to the books, to the firm's book. Okay, so these are all the potential adjustments. Let me use this example. Okay, so the firm is Nugget Mining, okay, and its book balance, cash balance, $2,502. But the bank statement shows a different number, 22,190. So the difference is because of these following, reasons, or these are to be reconciled, items to be reconciled. Let's see. The first one is deposit that the firm mailed but does not appear on the bank statement. See, the firm mailed these $30 deposits. Okay, so the firm will recorded this $3,680 to their own book, right? But the bank will receive this deposit probably in December someday, and then take days to process these payments, right? So we should add these cash inflow to the bank statements. And let's check. The bank statement were 190, right? So we added the deposit in transit to the bank statement. Yeah, because when the firm mailed the check, it actually mails a deposit. This amount of money was recorded in the book as cash inflow. So in other words, the firm debited this cash by using a journal entry, but there's nothing update in the bank statement on November 30th. Okay, so this is one example. And the next one is check written in November but not charged to the November bank statement. Okay, so these represents cash outflows. Why? Because they are cash written by Nargate Mining, but also their charges, right? And the total is these three checks. The total is $5,000, or $5,001. Okay, so these are cash outflows. They were recorded in the firm's book. Yeah, so we should manually subtract this amount of cash from the bank statement. Okay, again, let me check. Oops. Okay, so here I deduct outstanding check $5,001. Like here. The next one is Nargate has not yet recorded the $600 of interest collected by the bank November 30th on Sequoia Company bond held by the Bank of Nargate. Okay, so this is actually Nargate Mining Company's investment, and the $600 interest was recorded by the bank, right? So we don't do any adjustment to the bank statement. Instead, we make adjustment to the firm statement by adding this cash inflow because there are interest collected, right? So we add $600 to the firm's. Yeah, so here, this is a bank statement. Oh, this is a firm's cash balance. We add 600. Okay, yeah, because they were recorded by the bank, but not by the firm itself. The next one, bank service charge, $18, are not yet recorded on the Nargate. Yeah, so this is a charge by the bank, right? So that means this amount has been recorded by the bank, so we should adjust to the firm's book. It is also a cash outflow because it is charged, right? Yeah, so let's see. $18 C, bank service charge. We make the adjustment to the firm's book. Next one, the bank retained one of Nargate's customers' check. Okay, so this is a customer's payments. Okay, however, this is a NSF check, non-sufficient fund check. So in other words, the firm, the Nargate Mining, recorded this check as a cash inflow. But for the bank, they do not, recorded this 220 because it is NSF, right? So for the bank, it is nothing to be recorded. However, these $220 were recorded by Nargate Mining. It is overstatement. Why? Because although it was a check by the customer, but there's no money, right? So we should make adjustment to the firm's book by subtract $200 from the original cash balance. Okay, why? Because $220 was counted as cash inflow by debit this amount, right? However, it is NSF, so we should subtract. Okay, the next one is number 6. Nargit Mining discovered that it incorrectly recorded check. So this check was a payment, okay, written in November. So it recorded the payment for 131, but actual payment was 311. Okay, so that means this is a cash outflow was understated by or was overstated by $180. Okay. So we should add back this error to the firm statement, okay, because this is an error made by the firm. Okay, so let's go back to this one. $180 add back to the firm's book. Okay. The next one is a check for Nugent Oil Company in the amount 175 that the bank incorrectly. So this is an error made by the bank. Charged to Nargit accompanied the statement. Okay, so this was a deduction from the bank, but actually it was an error, so we should add back 175 back to the bank statement. Okay, so so $175 was added back. Okay, originally it was a charge to the Dugent, okay, not the Nargit Mining Company. Okay, so based on all the 7 elements, and after all these adjustments, finally you should be able to get the ending balance of both, okay, and their amount should be the same after reconciliation. And for the firm here, keep in mind we are preparing cash balance for the company, right? Instead of reporting $2,502, we should report it $21,044, which is a correct cash balance. Okay, so we should make a journal entry to account for these adjustments. Okay, so adjustments includes these 4 items. Okay, 2 cash inflows and 2 cash outflows. So the journal entry actually is this one. Okay, 4 items, right? There are 2 deductions we made. The other 2 cash additions. So also the debit cash $542. Okay, so that's the net adjustment for these 4 adjustment we reconciled in the prior table. Okay, after making this journal entry, the firm should report the cash balance $21,044.